Discuss about preliminary valuation exercises on various financial instruments. Now, there are basically two, something like a security. Our discussion on financial management. Under Unit 2, we are going to discuss about preliminary valuation exercises on various financial instruments. As we continue our discussion on financial management, under Unit 2, we are going to discuss about preliminary valuation exercises on various financial instruments. Now, there are basically two broad categories of instruments that are available, commonly known as fixed income securities or equities. And we're going to start with basically the fixed income securities first and try and understand what those are and how does the process of finding a present value get implemented in terms of doing valuation for something like a security, and how do we extend that process eventually in terms of common valuation of stocks or equities of a company as well, right? So that's the broad premise, and that's what we're going to kind of pick up. Under this particular unit, we are going to have firstly valuation one on introduction to fixed income securities and the entire portion around fixed income securities. What are fixed income securities? What are those markets? What are some of the key terminologies? How do we price a bond? What is the term structure of interest rates, and what are various risks that are kind of in place when someone is investing in bonds or fixed income securities, right? Uh, Subsequently, we'll move and do the same stuff for equities as well, or stocks as well, and try and see how does the net present value concept apply there as well, or how does the IRR concept apply there as well, right? That's the broad premise of how we are going to kind of incorporate this particular section. Let's begin with this one first and try and understand the first few portions of this. What exactly is a fixed income security? Before we go into finding out what the value of a fixed income security is, let's first define what is exactly a fixed income security, right? Now, imagine that a company borrows money from a bank, right? That's as simple as a corporate loan that the company has taken. Let's assume that the loan is 100 crore, right? If it is a 100 crore loan, effectively the total principal value of the loan is 100 crores, right? Now, instead of going to the bank, let us assume that the company actually chooses to borrow this money from individuals, right? Earlier they were getting it from a bank. Now we are saying it will take it from individuals, right? And this can be done by, for example, earlier this was the company and they were taking the money from the bank. Let's say this was the bank and the bank was giving money. Now, obviously, if you're taking money from individuals, one individual cannot give you 100 crore. So you'll have to take it from multiple people. So what you do is you go to a set of people, and to each of these people, you issue what is called as a certificate, right? Anyone who holds this certificate is entitled to some payment from the company, because this is the certificate that defines that someone has lent money to the company, right? Now, the company could, for example, issue 1 crore certificates of rupees 100 each, right? So 1 crore certificates into rupees 100 each would mean a total loan of rupees 100 crore, same as the earlier case, just that in this case, rather than taking the loan from one entity like a bank, the company has raised the money from 1 crore different individuals. It could be less than that, because one individual could buy more than one certificate. Once you get a certificate, in lieu of that, you're paying 100 rupees to the company. And effectively, the transaction that has happened is that in both the cases, the company has borrowed 100 crore, right? In both the cases, the company has borrowed 100 crore. Now, let's understand the premise of this in terms of interest. If the loan tenure with the bank was 3 years and the interest rate was 8%, then the company would be paying an interest of 8 crore to the bank every year. Effectively, if your interest rate is 8% that you're giving on a 100 crore loan, you have to give 8 crore every year to the bank, and you would have returned 100 crore at the end of the 3-year period. That's the principal repayment that you will do to the bank, correct? Now, in the second case, however, what will happen is that the company will make a payment every year to each investor. So each investor who holds a certificate in year 1, 2, and 3 will get a payment of rupees 8. Why 8 is because each certificate is worth 100, right? And because there are 1 crore certificates, the total payout will become 8 into 1 crore, which is 8 crore, right? In the third year, you pay 100 per certificate. Again, 1 crore certificate, which means 100 crore. Now, this is again going to be exactly the same payout as what the company would have done to the bank. 8 crore every year for the first 3 years. And at the end of the third year, you're going to pay the 100 crore back, right? The certificate, the certificate that the company issued is what is known as a fixed income security, or more commonly as a bond, right? Why is it called a fixed income security? Is because it's going to give a fixed income of rupees 8 every year till its tenure, and is eventually going to give back the 100 rupees at the end of the tenure, right? So a fixed income security is nothing but a sort of a loan. Essentially, if a company is borrowing money instead of from a corporate, from multiple corporates or multiple investors or multiple individuals, the company would issue some sort of certificates in lieu of those borrowings. Each of these certificates is effectively a bond or a fixed income security, and essentially it's nothing but a sort of a breakup of a bigger loan. So if the earlier concept was that the entire loan was taken from the bank, now you're breaking that loan into smaller chunks and taking that from individual investors or corporate investors, depending on what the demand of that loan is. Now, the guys who are giving you this money and taking the certificates could be individuals, could be funds, could be corporates, could be other banks, could be anyone essentially, right? So the entire concept is just that you're trying to create a security which is going to generate a fixed income stream. Every year or every period, there is going to be an income. That is why it is called as a fixed income security. In simple words, it is nothing but a loan, right? Always remember that a fixed income security is a loan, is a debt. Whenever you talk of bonds or fixed income securities, these are all kinds of debt that the company has issued, right? Now let's understand the basic features of how does this work. The company which is borrowing is known as the issuer. So the issuer is also the borrower. This person borrows the money. At time zero, this borrower issues a fixed income security towards the investor, who is also the lender in this case. The money is being lent by the investor, right? The investor pays cash at this time zero to the company or the borrower or the issuer, right? So the security is issued. In our case, we had said each security worth 100 rupees, and the cash was paid to the borrower at this point of time. Whatever is the tenure of the bond, let's assume that tenure is R years. Whatever R years is, 1 year, 2 year, 3 year, 4 year, whatever is the fixed period of this loan, from time zero to time R, the interest is paid on an agreed frequency. In our case, 8% yearly for 3 years. That's what we had discussed in our previous case, right? 8% yearly for 3 years is going to get paid from the borrower to the investor. At the end of the period, the borrower will repay the principal back, in our case 100 rupees back at the end of time R, or 3 years as we were discussing in our case. And at this point of time, the security or the certificate is returned back by the investor to the issuer. So essentially the security is meaningless after this. There's no more meaning that is left of the security. The security is given back by the investor to the issuer or the borrower in lieu of the principal being repaid back. That's the basic feature of a fixed income security or a bond. This is exactly the same as a loan where the borrower could be a company and the investor or lender could be a bank. The bank gives money, the borrower keeps paying interest at a regular frequency and then eventually pays the principal back. Just that in this case, in order to make this instrument a viable alternative to a loan, what happens is the instrument, which is the bond or the certificate or the fixed income security, right, that we were saying, this could actually change hands. What do we mean by changing hands? Essentially, it's quite possible that the lender initially was person A, and at some point of time, person A actually just gave the certificate to person B. That is possible in this case, which usually is not seen in the case of banks, right? If I borrow money from a certain bank, I have to repay money to that bank, right? But if I give a bond to an investor A, I keep paying the interest to investor A till the time investor A holds the bond certificate. But if investor A gives that to investor B here, then the payments start going to investor B. So whoever holds the bond certificate gets the payment, which allows people the flexibility of getting out of this particular instrument at any point of time, right? Unlike the previous case, if a bank gave money to the company, unless the company pays it back, it is unlikely that the bank can get out of this deal, right? But here, because there are investors A, B, C, D, E, F, and so on and so forth, it's quite possible that investor A sells the security, sells the stake in the security to another investor X, right? And then essentially the claimant in this is X and A is out of the deal altogether, right? This security, by its very nature, allows this transaction to happen, right? And because A can sell it to X, there has to be a mechanism to find the value of this. What will X pay to A, right? What is the value that has to be paid by investor X to investor A? That has to be clearly determined by using certain mechanisms, right? That is where valuation of a fixed income security would become important. So in principle, this is nothing but a loan that is being taken in lieu of certificates that are issued, and you're giving interest for the period of the loan to whoever holds the certificate. But the way it becomes slightly different from a loan is that the certificate can be traded. The certificate can be sold to various people, and because it can be sold to a variety of people, that adds a little bit of freedom in terms of someone who's investing because they have liquidity. They can sell it and take their money and move out depending on what their conditions are, right? And that defines a very important point that pricing becomes a very interesting scenario in this case, because during the course of this tenure of 3 years or 4 years or whatever number of years the loan is, the security can keep trading in the markets, financial markets. And when it is trading in the financial markets, obviously the price can keep changing. We'll come to how do we define that price and what are the implications of that price decision making in a few minutes. But at this point of time, what is important for us is to understand that a fixed income security is like a loan. The only difference being it's like a certificate that is issued that can trade in the markets, right? Let's understand how a fixed income security gets issued in the market, right? So the issuer, who's the borrower, would come to the market with a certain number in mind, a number of securities at a certain interest rate offer. Let's say there's a company called XYZ Corporate Limited. They come to the market, they want to raise rupees 50 crore, and they come to the market and determine what possibly is going to be an interesting rate for them, right? So they come to the market, they say we will issue certificates or let's say bonds, and each certificate would be worth rupees 10 each. So we are going to issue what? 5 crore certificates for rupees 10 each, right? Now, how much interest they have to offer is for them to actually gauge from the market interest. They will decide, okay, if I give 8%, will the market take it? If I give 10%, will the market take it? Based on that decision, they will take some market information. There are mechanisms of arriving at this. But let's say they zero down and say we will have to pay 12% interest, right? So they will go to the market, offer these bonds, saying, let's say these are bonds for 5 years, right? Let's assume 5 years. And they will say this is the feature of the bond, that every year for every bond that you hold, you will get 1.2 rupees. Why 1.2 rupees? Is because rupees 10 into 12% is effectively 1.2 rupees. And at the end of the fifth year, you will get your 10 rupees back as well. That's the payout that this security will give to anyone, this company would give to anyone who holds this security in the market. What is important, however, is that it is up to the market to determine whether they accept the price and the interest rates. This person might come and say, I'm going to sell it at 10. The market might define whether they want to buy it at 10 or less than 10 or more than 10. That's like, simply put, the company will come and do an auction, right? They'll just come to the market and say, we are issuing 5 crore certificates. Now, whether the market decides to buy or does not decide to buy is completely up to the market. There is no compulsion that the market has to buy at 10 rupees, something that is given 12%. The market might believe that, if you had offered 13%, we would have bought. At 12%, we are not interested, right? So the company might go back and change this entire thing to say that instead of 12, we are going to give 13%, in which case the cash flows would change to 1.3 every year, right? And then the market might buy it. But that's how a security is issued. Typically, a company would go to financial markets with an offer, and the market decides whether the financial offer is worth buying or not buying. Right? We'll come to those again in a moment. Let's understand some key terminologies which typically come in with a bond or a fixed income security. There's something called as the face value of a bond, which is usually the price or the value at which the bond will be redeemed. It's in effect the principal value that has been agreed upon. So could be 100, could be 10, could be 10,000, depending on the bond. It could be anything. Usually is a multiple of 10. Usually it's a multiple of 10. But you could have 10, 100, 1,000. India, a lot of the bonds are denominated at 1,000 rupees, many of them at 10,000 rupees, and so on and so forth, right? That's the value at which the bond will be redeemed. Now, just like our previous case, ideally, it should have been issued at 10 and it should have been right. This 10 here, which is being given at the end of 5 years, is what the face value is for a bond. It may have been issued at 10 as well. That's the issue price, the value at which it was issued to the investor. Now, let's bring in the market into the condition. Let's say I have a company XYZ, which wants to borrow rupees 10 from one investor. I come to the market and auction it at 10, but it doesn't get issued at 10. Someone buys it only at rupees 9. The bid that I get is only at rupees 9, right? Now, in these cases, the issue price could be slightly different from what the face value is. Otherwise, for practical purposes, at this point of time, what we want to believe is that face value and issue price are going to be the same. We will relax this assumption as we go along, right? Then there is something called as the coupon rate, which is the interest rate that will be paid to the investor. It is always expressed as a percentage of the face value. 12% or 13% in our example was the coupon rate, right? From now on, the interest that is being paid on the fixed income security will be referred to as the coupon rate, right? What is the frequency at which the coupon is paid? Is it yearly? Is it half yearly, monthly, quarterly? So 12% paid yearly will be rupees 1.2 on 10 or 12 rupees on 100 rupees, right? But 12% paid half yearly will be 0.6 and 0.6, right? So it is important to know whether the frequency of payment is yearly or half yearly and so on and so forth. That's where the principle of compounding also becomes important. If you remember, we've already seen that if the payment frequency is more than once a year, the effective interest rate will increase, right? That's because the amount is being paid out earlier and that amount can generate more amount, right? Then we have this term called maturity or tenure of the bond, which is the period after which the face value will be returned. In other words, the loan tenure is what we are looking at, right? That's the maturity or tenure. And finally, the current price. If the security is listed, the last traded price of the bond, it could be different from the issue price and the face value. It got issued at 10, but it might be trading at 9.5, it might be trading at 10.5. That's entirely what the market defines it to be. During the maturity period, let's say it's a 5-year bond, it gets issued at 10, which is the issue price. It gets redeemed at 10, which is the face value, but in between it can trade at any price depending on the need and the demand and supply mechanics of the market. That's what is called as the current price, right? So that's the broad important terminologies of a bond. Let's take an example. Let's assume that Tata Motors issued a 6-year bond with a face value of rupees 100 on 1st of January 2011, right? The bond was issued at 102. Now that's the issue price. Remember, the issue price is 102. And the face value is 100 in this case. And as on 8th Jan is trading at 101, the bond would attract a coupon rate of 11% payable half yearly. 11% payable half yearly would mean 5.5 and 5.5. Remember, 11% of the face value is 100. So that's the payment schedule. It got issued on 1st of Jan. 30th of June, it will pay 5.5. After 6 months, another 5.5. Then 6 months and 6 months and 6 months and 6 months. You will see the number of payments will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. That's 12 because this is a 6-year bond and paying half yearly, right? So 2 payments a year, 6 into 2 is going to be equal to 12. 5.5 each period is going to be paid. Last period is going to be 100 plus 5.5, 100 being the face value of the bond that gets redeemed at 100 eventually. Issue price, the company might have wanted to issue it to at 100, but they probably raised 102 because there was some investor who was willing to pay 102 for this bond. The maturity or tenor is going to be 6 years, and the current price, the bond was issued at 102, will get redeemed at 100, but in between this period can trade at any price. And it seems that as on 8th Jan 2013, somewhere here, the bond is trading at the price of 101. That's the current price, right? We'll come to how do we define the current price. That's because that will involve a little bit of concepts of valuation of the bond as we go there. But that basically is an example of a bond. How does a bond function and what these instruments carry with them in terms of nomenclature and what are the key terminologies that any bond will have with itself, right? That's where we end this particular section.